pleasure to introduce this session today on restricted schemes. So our panel, I'm sure for most of you, are very familiar faces and really hardly need an introduction. But for the record, Tim McGuinness on my immediate left is going to facilitate the session, and Tim is a very experienced, long-serving professional director and licensed independent trustee and has been involved with workplace savings schemes for many, many years. Next to Tim we have Gavin Quigan. Gavin's current title is Principal Advisor, Restricted Managed Investment Schemes at FMA. And as most of you will know, Gavin's the very approachable face of FMA. Whenever you've got a problem, he's the one you get on the phone to and talk to. Next to Gavin we have Mike Woodbury, a partner at Chapman Tripp, and Mike has a wealth of experience, not to mention his singing talent, that in the legal field around restricted schemes, workplace savings schemes and managed investment schemes. And on the end, last but not least, Bernard Reid, an actuary with MJW who also has many years of experience in advising schemes on actuarial issues, investment issues and other issues with workplace savings schemes. So please join me in welcoming them to the stage.
Thank you, Janet. I wish these lights weren't so bright. Anyway, because then I could see who I'm looking at. But anyway, we're a bit of a hard act to follow from the last one. We're sort of coming down a level to be a bit more specific about a sector of the industry, and we have a great bunch here. I look at us and say, well, we don't really tick the diversity box that well, but I like to think there's still a reasonable amount of experience and value to be had out of my august colleagues talking about experiences in this sector in particular. What we thought we would do today is just sort of have a look at a couple of different aspects on the restricted scheme space, maybe a bit of a report card type look at a few aspects. How are things going that have cropped up? You know, we've got a particular carve out, a particular way of working. So how's that playing out in practice? You know, what's good, what's bad? And then also just to bring you up to speed on a few of the work in progress, things that are coming down the track. So what are we looking forward to? What are we working on? So very, we've got a sort of a general discussion list. Depending on time and questions, we may or may not get through them all. We'll just see how we go. So, but like we did last time, I thought was a really good start was just to put a bit of shape to the industry or the sector as we've now got it. So what I thought we would do first is just put up some general statistics of what the restricted scheme market is looking like. And Gavin, I might start with you just to take us through, from your perspective of the FMA, what you're seeing in terms of the makeup, the changes that have emerged over the last couple of years since FMCA transition, and what you see is still coming down the track to how that might reshape going forward.
Thanks very much, Tim. Yes, I took the opportunity to sort of go through off the disclosed register just to get an update for everybody of the current position in relation to workplace savings schemes. But then I thought, you know, I often get a lot of questions about, so we've got defined benefit schemes and then we've got hybrid schemes, and what's the difference there? And I thought it was very important to sort of also look at the fact that we've got 22 schemes that are still open for business. In the workplace savings breakdown there, you've got 40 defined benefit schemes that are basically the pure ones. The hybrids, 7 of those are open, and then half of the defined contribution schemes are open to new members. And stacking up, you know, from 2017 to 2018 at the bottom there, we've only lost so far 5 restricted schemes. And that breaks down into 2 workplace savings schemes. One of those schemes, the trustees chose to wind the scheme up. The employer had set up a master trust participation scheme, and the members were given the option of, if you want to invest some of your wind-up benefit, then you can go and invest it in the new scheme. Nice, easy, clean way to transition across to the new regime. The second scheme that went the other way, they did a compulsory transfer, and that went just as smoothly. And that's pretty much complete. Going forward, I've got 3 that I'm aware of that are seriously looking at in the near future, either winding up or using the compulsory transfer regime. And longer term, I know of a couple more that next year will be doing something. So I suppose from an industry perspective, there's still $14 billion worth of assets, 105 schemes, 163,000 people are still in workplace savings or legacy retail products. The pensioner numbers were a bit of a surprise to me. We're down to 17,000 pensioners, and looking at the numbers, clearly there's been a few schemes where some cash out offers have been made, and people have taken those up. So it's, I think that's probably about all I'd have to say on that slide. And then
just push screen.
Yeah, oh. I thought, let's look at it just from a slightly different perspective. We had the old Super Schemes Act 89 regime. We knew what the numbers looked like under that regime, so if I bring in current retail on market super schemes, the non-restricted legacy schemes, and of course the master trust products, NZRTs, Super Life, etc. Suddenly we've got an industry still outside of KiwiSaver, bar the 5 restricted schemes, of a growing number, 24.5 billion, up from 23 billion. So yeah, there's obviously still a lot of interest by employers to provide something additional or different to KiwiSaver for their employees. And I think that personally there needs to be more recognition that this is still a viable, solid part of the retirement savings portfolios that people have. And I commend Workplace Savings for the work that they're continuing to do, and jointly with FMA in many cases.
Mike and Bernard, you're both providers, key providers to the sector. Just very quickly, just your snapshot of what you're seeing among your client base and current attitude to continuation or whatever. Just any quick observations you'd add to that?
Yeah, I mean, the slow rate of attrition has surprised me a little bit on the upside. In terms of size, shape and trends, just an ongoing somewhat lower rate of wind-ups, full or partial, bulk or consented transfers to master trusts or scheme consolidations than might have been anticipated. For the most part, it's the now customary sort of pause for thought factors that we're all familiar with. A meaningful subset of the continuing schemes, and I'm looking at a few of them here, because remember, restricted scheme status is grandfathered. We're not minting any new ones. It is a slowly sinking lid. Remain major managed funds in their own right. And they're satisfactorily cost efficient due to, in meaningful measure, to the concessionary compliance regime, and they're doing great things for their members, and they're still among the very best communicators. Some are charitably tax exempt or otherwise have a religious reason for being, and that's a compelling one. For the smaller DB or hybrid schemes, purchasing scheme equivalent annuities remains, as we know, it seems prohibitively costly when lined up against the projected end-to-end cost of just managing down that slowly sinking lid. Other factors have also come to the fore. As of last Thursday, the third of the three biggest, they're not the only, but the three biggest master trust providers obtained the requisite enabling exemption to onboard non-employees / pensioners into a master trust structure by way of replacement for a standalone scheme. Those accounts-based but defined benefit allocated pensions arrangements road tested, they're working well. Of course, the plans have got to be fully funded at inception and then receive triennial actuarial reviews and so forth. Are looking good, but as things stand, and with elderly pensioners, for example, the required unanimity in getting everyone into the new plan is usually just too high a hurdle. There are definitional issues getting in the way of consolidating legacy restricted schemes that are in the super schemes space. And lastly, there's just good old survivor bias though. Schemes and sponsors, some of them quite vanilla DC, are still quite wedded to tradition and autonomy, and good on them.
Yeah, I mean, we're seeing sort of similar developments. So the large DB schemes, I think, are here to stay. They've been through any number of reviews, they've been ring-fenced and they've been grandfathered. And just to pick up on Mike's point, the bit that surprised me is actually those sort of medium but not very large DC schemes, which I thought would be a no-brainer to transition to some kind of master trust, but some of them have decided to sort of stay and continue. I think we'll still see small DB schemes wind up and continue to wind up, but at the bigger end, I think they're going to be here for a long time.
Sure. Okay. Now, I should have said at the outset, throw your hand up if I can see you. I'll try and wave it around, and I'll try and take questions as we go. Going to move on to the section which just looks at a few things that are coming down the track in terms of the work program. And the first one I wanted to touch on is what's been termed the right-sizing review that's for restricted schemes that's started to be undertaken by the FMA. And perhaps, Gavin, you can start with this one and sort of put it in the context of what it is, where it came from. It started as an FMA initiative, but just sort of maybe set the scene and then get Mike to just talk very briefly about the key elements that we're thinking of doing with that.
We've got a slide on it?
Yes.
Thanks, Tim. So, just to set the scene, back in November last year, we hosted a forum with Workplace Savings jointly and providers, so service providers to all the restricted schemes, the accountants, the law firms, and some of the admin managers. And from that forum, I managed to twist Liam Mason's arm and had one of our senior policy people along as well. And I think from that there was some obvious issues that we felt there could be scope to do a exemption, some guidance, and just some comfort in some cases for some of the issues that were coming out and being put on the table on the day. So that's been formally acknowledged within FMA that there is the opportunity to do some right sizing. And the first cab off the rank is effectively the submission that Mike worked tirelessly on. I did a straw man at day one and said, here guys, take this away as an initial thought and build on it in terms of a potential exemption for custodian insurance reporting. And you know, Mike and Tim and the team have done a fantastic job in putting that exemption together. One thing that we always have to bear in mind is that as a regulator, we've got exemption powers, but at the end of the day, we cannot make new law.
Yeah.
And so if we're doing an exemption for a sector, and you know, we can't exempt everybody. There are compelling reasons why certain structures mean that we can take confidence on, in the custodian assurance report example, if everything's administered effectively a bit like the old Superannuation Schemes Act exemption for financial accounts, if you were fully administered by an admin manager who provided certain certifications to the government actuary every year, then you didn't have to have fully audited accounts for your scheme. And that's sort of the model on which I sort of suggested to everybody that we can move this particular one forward. We've received now, however, over 25 submissions last Friday, which we have to work through in terms of ensuring that we take everybody's feedback on board in determining what we will finally produce in relation to that exemption notice. The exemption notice gets drafted by PCO, and so in terms of, at the end of the day, where, in terms of timing, are we? It's a work in progress. But we'll be keeping Workplace Savings and the various industry participants that are looking for relief in this area up to speed with it as we go.
Mike, do you want to take on from that, talk about both the, you can wrap it up in the same conversation, the exemption application and the right sizing review in a wider context about the wish list type approach that we've got at the moment and how that's unfolding?
I might start with the custodial exemption proposal. As Gavin has alluded to, in practical terms, the exemption sought is from a restricted schemes trustee board or nominee company having to obtain an additional scheme-specific controls report, and that's the one obviously that costs nearly all the money, despite not performing any additional custodial as opposed to general scheme governance functions itself. And that's given the outsourcing of materially all of the custodial compliance function, exactly as they had promised in early August. FMA consulted on the detail of an exemption proposal and the exemption conditions, and we responded on deadline, which of course meant midnight last Sunday, and will do so on an ongoing basis, engaging in the detail. We would hope that a formal exemption can be reliably pending and in substantially final form in the reasonably near term during this calendar year, so that even if formal gazettal via PCO, as Gavin said, may then take some weeks, we know the lie of the land. We did consult, and that was really valuable. We have conveyed, it's looking really good, but we have conveyed some material concerns about the proposed permitted investment restrictions, and hopefully those have been received as valid in the sense of at least debate-worthy. Consultations highlighted that the requirement for, so one of the conditions is that 95% of the scheme's assets be invested in what are characterised, however they are characterised, as standard investments. And at the moment it's proposed that those be direct investments in managed investment schemes domiciled in New Zealand, which is most commonly the case. And indeed, when you invest overseas, you usually do it through a mezzanine or in sitting in operational cash. But what's emerged is that is going to be an unworkably narrow set of requirements in practice for a significant subset of schemes. And it's hoped that in particular direct investments in managed investment schemes domiciled in an approved list, so to speak, of overseas jurisdictions as well as New Zealand and Australia will qualify, as should term deposits. And I think if we can get those two over the line, then we will conform to our own 95% rule. As Gavin said, we'll never get everyone through the hoops. But the right sizing review, courtesy of the National Treasurer to my right, has been a fantastic initiative. We have given the regulator, I guess what amounts to a wish list at its invitation of identified pain points that are creating ongoing issues, as well as technical or indeed practical compliance concerns. And though it's deliberately inclusive, we know we're not going to fix everything. But equally, we've been told it's not a closed list, and that issues will go on emerging. Addressing some of the issues we've identified will, of course, necessitate law changes. We hope, though, that others can be satisfactorily resolved through exemption notices, guidance, or even just talking. How will it unfold? As I said earlier, the FMA won't agree with all of our suggestions, but others will fly and will help make your lives easier. It's a welcome recognition that one sizing isn't always appropriate.
Bernard, a couple on that list in particular from your client point of view, you think would make the most difference looking ahead?
Yeah, I think that the fund update is a hassle to do, and you sort of wonder really what the point of that is. And the other one is technical insolvency. That really freaks the auditors out. If you look at how a defined benefit scheme is meant to operate over its lifetime, on average, half the time it'll be above 100% funded and half the time it'll be below. So there's nothing really wrong with it being somewhere between 90 and 100. But a lot of the auditors, sort of, as soon as they see that word, it scares the horses a bit. So it'd be good to do away with that.
It's interesting to see the difference some of these things can make. Just the custodian exemption application. If the relatively simple structure, doesn't stretch too far, is enacted, my estimate would be that the scheme, which will be either the member or the employer, because we're all not-for-profit, will be something like $500,000 better off a year in lower fees. So there are material gains to be made in the longevity possibilities for the sector. The more we can right-size, which is the terminology we're looking at, the set of regulations that we have to work to. At the end of the day, they flow through to members, which is what we're here for.
We could talk narratively about the points on the slide there, but maybe it's more efficient just to say, do any of them beg any questions? Would you like us to elaborate on any of those? Sorry to butt in.
Good. No, please do. Yeah. So, or we can, you can think about it as I'll leave them there, and we can talk about them at the end as we go. The scheme sector has had a number of carve-outs and a number of particular circumstances, and one of them we have is the nature of our regulatory regime and the nature of our regulator. We're not missed. We've had the specific structure where we haven't had a manager-supervisor separation. We have a licensed independent trustee regime, which we'll get onto, but it does bring into play the role of the FMA being much closer. I know Gavin doesn't like being called a supervisor, but for all intents and purposes, I think he is. So I thought it'd be useful just getting the market experience of the FMA looking out, how they think it's gone 2 years on, is it working okay, what have the pain points been, and then for those in the industry to say, well, how have they felt working it back the other way? Is this model we have for restricted schemes fit for purpose? So Gavin, maybe your take on that to start with.
Thanks again, Tim. So overall, since December 16, I think the market is working well from my perspective. The quarterly reporting, whilst it's a pain at the moment in terms of related parties and limit break reporting, and it's a pain at my end too because we've got to look at them. But in terms of compliance, one or two might miss the deadline in a quarter, and most of the time I will have already had a phone call saying, sorry Gavin, for this reason or that reason we'll be a day or two late. Not a problem. An interesting statistic which I pulled out is that in the 12 months to 30 June I've looked at and given consent to 22 trust deed amendments for restricted schemes. I think there's possibly only one or two of those where there was a bit of discussion, and perhaps a tweak to the amendment. But everybody in the industry knows what's expected, and that runs very smoothly. I think the one area which is have had a little bit of difficulty with, even though there's only been a couple, is just the wind-up process, and the fact that you don't have lodgement on the disclosure register. Everything is in fact old school. The wind-up resolution comes to the FMA. The final accounts come to the FMA, and the fees payable directly to the FMA. So, yeah, that's an area which I suppose because we've had so few, people have sort of not realised in some cases what the obligation is.
Mike and Bernard, do you want to take from, looking from your side of the sector back into the regulator and how it's panning out?
It works well. I mean, I think it's sort of, there's a no surprises sort of atmosphere, so, we can always talk to Gavin on a no-name basis if we need to, so, it's always worked pretty well, so. Yeah.
It is positive, to my mind, with good mutual engagement, and that's been the case even though the FMA are of course no pushover, and we wouldn't want them to be either. We believe in consultation and dialogue, and we pass that through to our clients, and dialogue with Gavin and his exemptions team or other relevant colleagues in particular results in propositions being tested, and it's good to be tested. An amendment, a transfer, a new plan establishment or offer process is invariably, in my view, made better by FMA's early involvement. They want open dialogue and to work with willing compliers, and Gavin alluded to it earlier. And mistakes happen. We're still in year two, and so too do technical breaches or indeed less trivial non-compliance concerns. If in doubt, talk it out. Don't fudge. Evince a desire to put it right, because frankly FMA can and will smell bullshit a mile off. So keep the lines open.
And from my point of view, as Mike said, I'll put my hand up to have had to have a couple of reporting requirements to Gavin for, I call them minor technical breaches. I don't know what his attitude was. But the underlying experience has been fantastic, and I would continue to commend the FMA, both in Gavin's team and in wider, that if you're trying hard and communicating well, then there is no problems, there should be no issues. You will find a way through your problems, and you quite rightly, if you don't, then you'll get to serve you deserve. I think it's working particularly well at the moment. So, and the evidence of the interactions between the FMA and Gavin in particular in the sector, and making progress in things like the right-sizing review, the exemptions and those sort of things. We are engaged, and they are engaged to improve the outlook for our members, which is what it's all about. So that's cool. One other part of this particular regime for restricted schemes was the introduction of the licensed independent trustee regime. Again, not having separation between manager and supervisor, but to bring in the minimum requirement of at least one licensed independent trustee. We thought it'd be useful 2 years on to get your perspectives, both from the FMA looking out and a couple of key advisors, how you have seen that regime working in practice. Has the game been lifted? Is the model working as intended? Are the obligations being met? Is there further ground that could be improved on? So, Mike and Bernard, I might start with you this time, looking in from your perspectives, from your client base. You've seen the change in practice. Yeah, what's your take?
It has added value, but I've seen it evinced best when there's a true outsider's perspective brought to bear, which adds both expertise and something of a whole of market perspective. So I do think real as opposed to technical independence, i.e. being joined by a third-party market services professional, is probably what's optimal, and I just say that in principle. We have, I think, seen the value adds flow through best when the lit in question has something of a wider scheme governance footprint. What are those value adds we're seeing? That's the rhetoric. What are we seeing? They include, in some cases, taking on something of a semi-executive role and being on the front line of month-to-month service provider liaison and leading special projects, for example. In others, it's as anodyne as just updating your co-directors, your co-trustees on issues encountered and knowledge and insights gained from forums such as these, attendance at workshops, experiences with cyclical and event-driven reporting, disclosure and other compliance requirements for other schemes, involvement with submissions and initiatives on matters of interest. So they're adding value. They're adding value as an independent professional director voice at the table.
Yeah, I mean, I agree. I think in some ways it's made my life easier. So a common situation you get with a sort of a smallish DB scheme is that two of the trustees may be the CEO, CFO, and you've got these conflict issues all the time, and having an independent person there as well, it's just another voice around the table which sort of reinforces that they've got different hats to wear at different times. The other thing that sort of I'm seeing is that you get this cross-pollination of ideas. So you'll have a lit who is a lit on a number of schemes. So you get this sort of transfer of ideas from other schemes. And so you're getting a lot more sort of sharing of best practice and good ideas, which I think is great.
And Gavin, from the regulator looking out.
So we've now got 34 licensed independent trustees, plus the 3 corporate licensed independent trustees. Plus, I've got an application on my desk now for number 35. And I've had a discussion with another person that could be number 36. So I think from my perspective, I've been thrilled that there's still new blood coming in to this area, and feel that they can make a living out of it, or semi-retirement or whatever. But yeah, so whilst the number of schemes, I think there's the odd person that's realised that there's actually more work in being a licensed independent trustee, and if you've got 5 or 6 schemes, then there's a lot of work involved in that, and maybe 4 or 3 is a better number. So it's certainly great to see that we'll have some younger people coming on as older people who have been effectively independent trustees of some of the larger schemes for many, many years, that they'll be able to pass on.
You're looking at me.
Yes, from my perspective, I've been asked, and what happens next year? There are some lits whose licences will be up for renewal. All I can say at this stage is FMA is currently looking at the licensing process and what renewals will look like, and there will be some targeted consultation in this space, and ultimately all will be revealed by February next year. And I think it's a few months after that before anybody needs to actually put a licence application in if necessary.
Is that okay, Bruce? You're number 1, I think, aren't you?
One, yeah.
Thanks. And Mike drew a couple of comments which I just want to reinforce as a lit, really. I've always banged the drum from day one that actually the lit part of the job, if you do the professional director part of the job properly, the lit part of the job should actually never much come into play. So the focus is being and providing professional director services in a specialist way to your schemes and your members, and that's the focus first. And the obligations as a licence holder, I won't say second, but it should be secondary if you do the first one really well. the other experience that we draw on, which again Mike alluded to, is the nature of our businesses where we have no management and we have a full outsourced model generally is the one applying. Just naturally means you have to get your hands dirty. The technical separation between governance and management sometimes just doesn't work. The reality is the one who knows, likely to know the best and the most about how to do stuff is going to be the professional director. And that's just the way life is. And I think there might have been a bit of a wake-up call or a bit of an unexpected workflow that came to some because of that, but I think that's settled down. I hope that's settled down, and everyone's found their right balance. The one thing we always have to watch, which I've had to watch even when I was before the lit regime came in, when you have a board structure with one professional, the danger of a governance structure where everyone relies on the decision making of one director, and you need to make sure you work your processes around that. To make sure that the decision processes are still robust, and that brings me on to a sort of, I guess, a wider question of, yep, you've got lits into the board structures, but have you seen a lift in the game of the governance in general across the sector since FMCA, which tried to drive change and improvement across the financial sector in general? So coming on to this issues of conduct and activity and focus of directors, any sort of just general comments about the standards and the confidence members can have about what actually happens?
Yeah, I think definitely it's improved. And like I say, was saying before about this cross-pollination idea. So you'll have a lit on one board who'll come to another client and say, hey, with my other clients, we have this register or we do this, and I think it's best practice if we do that. So you automatically get the benefit. So I'm seeing more sort of standardisation of how meetings are run and the things that are done and talked about. So I think it's good.
And I'm seeing a slightly better focus on, and I know what you mean, because sometimes the governance management divide's more apparent than real, but more of a focus on governance on the long term, as was alluded to this morning. And these professional directors are bringing in not just compliance calendars and all that sort of black and white stuff, but also prompts around things like cyclical service provider reviews and strategy reviews. These guys get governance, and so use it to better effect. One of our client boards even went a little bit further, and they took on IOD advice. They went and spoke to Institute of Directors and got some advice on how the board of the $110 million scheme was functioning. And IOD's advice was consistent with what I just said. You need to do more in terms of succession planning, strategy, and look at the lateness and the prolixity of agenda papers. They're too long. Take a less is more approach as an outsourced admin manager, and people will be able to lift their heads above the trenches. Henry Elliott spoke to us yesterday on this, and he said the same thing. Boards need to focus less on operational efficiency and more on strategic thinking. So I think LITs are helping drive that a little bit. And it's a difference of degree, but it's there, it's real.
Gavin?
From my perspective, I suppose I sort of sit outside, so I hear this from licensed independent trustees. I've had a number of licensed independent trustees ring me up and say, there's an issue here, or how do we deal with something? And, as always, my door is always open. Sometimes it is a new and novel issue, which is even more fascinating, as opposed to the ones where I can say, well, actually, yeah, I've been there, I've seen that, and this is the way in which it was resolved previously. So yeah, it's probably about all. Thanks, Tim.
We're running out of time, but also conscious that I've not had any opportunity, or whether there are any particular questions from the floor that you'd want to drive now, or you can address with one of us afterwards. So we only had one really quick topic to finish which was just to alert you to something in Werner's court, which was actuarial standards, which is I won't say makes my eye glaze over, but it's all yours.
The exciting part of
Anything
the
you want to say
session.
very quickly? This is, again, something coming down the track that might have an impact on a reasonable section of this sector.
Yeah, I mean, we've almost finalised, the Society of Actuaries almost finalised a new standard for reporting on defined benefit schemes. No real significant changes. I think we've tried to be less prescriptive and more principles-based, but the outcome will be very, very similar to the sort of reports that you all know and love under the previous regime. It'll probably be enforced sometime later this year. It's just going back to Council now. But the one thing which has changed under the new regime, which is actually not in our standard, is that the FMA typically likes deficits to be cleared within 5 years now. Under the old regime, it was quite common to clear deficits over a longer period. That's not actually anything to do with our standard, but that is just one thing that schemes will notice has changed in the new regime.
Okay, I think that wraps us, but time's up. I think from my take on the sector 2 years on, I'm really pleased of where we find ourselves today. I was really interested in Gavin's statistics, that there's sort of 180,000 odd contributors in the restricted scheme sector, 24 billion. It is still sizable, it has a future, and it is tracking well from my point of view. But there is more we can do, and in that sense, Workplace Savings and the FMA are working well together in furthering the interest of our members, which is what we're all here for. So thank you. And thank you, Montana.
So on behalf of everyone here, I'd just like to add my thanks to the panel for your insights, the time you've taken today to share with us what's going on and what's coming up. I'm sure there was something in there that would have been useful for everybody. So thank you very much for that. I'd just add my plug too to Tim's and Mike's comments. You've got the list that's been up around issues that are being looked at the moment, and Workplace Savings is very keen to work with FMA over helping restricted schemes get rid of some of their annoying compliance issues. So please do talk to Mike, who's a councillor, or me if you want to have any input on those, or you've got any comments that you'd like to make. So thanks everybody. Please join me in thanking the team.